So I'm going to go ahead and call the meeting to order. And I would like to ask Cynthia Joyner to call the roll.
Okay. Ms. Broad,
Here.
Ms. Coleman,
Present.
Mr. Battaglia. I'll come back to Tom. Mr. Hallquist,
Present.
Mr. Kenny,
Here.
Maji,
Here.
Mr. McBride,
Here.
Mr. Provolos,
Here.
Ms. Spoon.
Morning, Cynthia.
Good morning. Ms. Spoon,
Here.
Mr. Udries, Mr. Wallace,
Here.
Mr. Shearson,
Good morning.
Mr. Kaufman.
Here.
Okay, I know Tom Battaglia.
Here.
Okay, so we're just missing Almas.
Okay, so we have a quorum.
Mm-hmm.
Okay. Thank you for that.
Yes.
So, welcome to our second Zoom meeting. I trust it'll go very well like the last one. I just want to say that when we are voting on action items, Cynthia Joyner will call the roll for the vote. I would also suggest that if you're making a motion or a second, that you say your name rather than just saying motion, because we might not know who you are. Okay, thanks very much. Cynthia, do we have any public comment?
No public comment.
Great, thank you. So our first action items today are, our first action item is the approval of consent agenda items A through D. And may I have
Okay, so
moves.
and a second?
McBride, second.
Thank you.
and who
And can we
moved?
call
I'm
the
sorry.
roll?
Okay. Tanasi first.
Tanasi moved,
and
McBride second.
Okay, we're ready to vote. Ms. Broad,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Hey, aye.
Mr. Kenny,
Yes.
Mr. Maji,
Yes.
Mr. McBride,
Yes.
Mr. Provolos,
Yes.
Ms. Spoon,
Yes.
Mr. Udries,
Yes.
Mr. Wallace,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 13-0. Yeah,
Great, thanks very much.
I just called him.
Next, we're moving to business operations, and today we have 4 very important action items. The first one I would like to make a few comments on. We need to confirm a board vice president for the next year. As you know, I was confirmed as president for my second year in May, and now it's my responsibility and honor to appoint or nominate someone to be vice president for your approval. And it probably comes as no surprise that I am nominating Karina Coleman, who has been the vice president for the last year. I think we can all agree that Karina Coleman is a very talented professional, very knowledgeable about investments, and also has a deep understanding of what we do at SDCERS, always contributes a lot to our discussions and our deliberations, and is also a very delightful person to work with. So I think we all enjoy her. And I'm pretty sure she agreed to do this. So with that, I'm honored to ask for your vote to approve Karina Coleman as vice president for the next year. And can I have a motion and a second?
So moved. Shearson. Second, Paul.
Shearson
Thank you.
and Coleman.
Cynthia, please call the roll.
Ms. Broad,
Yes.
Ms. Coleman,
Welcome to Zoom. Enter your meeting ID, followed by
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny,
Yes.
Mr. Maji,
Yes.
Mr. McBride,
Yes.
Mr. Provost,
Yes, and absolutely.
Ms. Boone,
Yes.
Mr. Udris,
Yes.
Mr. Wallace,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 13-0.
Great. Well, congratulations, Karina, and we all look forward to working with you in this role this year.
Thank you so much, and it's my great honor.
Yay, applause from the gallery. Okay.
Yay!
We're lacking something by not being in person. Okay, so the next two items are very important items that we do once a year, and this is really the only time during the year that we have the AON team present at the board level, and this is to review the asset allocation recommendation, which is very important because asset allocation is really the primary determinant of our investment performance. And we'll also, that will be presented by Steve Voss. And after that, we will have Katie Comstock presenting the portfolio structure and implementation. And both of these are action items, as I mentioned. So let me turn the floor over to Steve.
Wonderful. Thank you, Carol. And good morning, everyone. Can you all hear me okay?
Yes.
Yes.
Fantastic. Great. Let's go ahead and go to slide 4. And just as a reminder, and as Carol said, you see us, we come before you once a year to talk about asset allocation. And the reason why is fairly simple. We believe that it is the single largest and most important decision the board will make as it relates to its investment program for the $8 billion trust fund that we're all responsible for. Asset allocation is the single largest driver of your long-term success and your ability to meet your long-term needs. Every 3 to 5 years, typically a 5-year cycle, we do a fuller asset liability study. This is where Aon works very closely with your actuary, taking data from the actuary, taking data from your investment program, and then modeling out future expectations of your program. We did that last in 2018, and at that point in time, we reaffirmed the mix between return-seeking assets of 78% and risk-reducing assets of 22%. We're not making changes to that today. The purpose of today is to make sure that we have the right 78 mix and the right 22 mix, and to suggest any minor alterations between the two. Over the past 10 years, we've actually made a lot of changes to your asset allocation, and today we are only making a recommendation for a very modest change as it pertains to your opportunity fund, and we'll get to that in just a few minutes. Some of the considerations that we take when we do an asset allocation study is we need to look obviously at what your long-term needs and expectations are. What do we need to be able to achieve the actuarial assumed rate of return? More on that in just a bit. What type of inflation protection or circumstances do we need to consider? What are the costs that it takes to implement the program? And what type of flexibility do we have to implement the investment program that you all approve? It's important that we have the right resources, both internally and externally, to be able to implement the investment program. And we want to make sure that we have good risk controls in place and elements of diversification. And I left out liquidity. Liquidity is increasingly important for you all. It's something that we've spent the last 5 years looking at very closely. As you have a mostly closed fund, we do need to be mindful of liquidity of your program to make sure that you have ample liquidity to make benefit payments over time. Let's go ahead and go forward, if I could ask you to 2 pages to slide 6, please. So yesterday, the investment committee had a fairly robust and holistic discussion on risk. We looked at all elements of risk for the investment program. Today, we're only going to focus on the center of this table, item number 2, and then item number 3, as Carol mentioned. We'll have a presentation in a few minutes from Katie and Ashley on structure. Today, we focus on the center. We focus on asset allocation. And the key risks that we're trying to address are shortfall risk. Do we have the sufficient tools in the toolbox to be able to meet or exceed the actuarial assumed rate of return of 6.5%? I'm going to steal a little bit of Katie's thunder and tell you, yes, you do. That we expect the program will generate a return of around 6.5%. show you that that will be a bumpy ride and that it has been a bumpy ride, but we do believe the mix that you have between stocks, bonds, real estate, private equity, and other asset classes is sufficient to be able to meet your long-term return assumptions. Let's go ahead and go to the next slide, and I'll just hit some of the very, very key highlights. So we are reaffirming that the 78-22 is the right mix based upon all the facts and circumstances that we have in front of us today, and also based upon the capital market assumptions that Katie will walk us through. Those are the expected returns from stocks and bonds. Your program remains very broadly diversified across major asset classes. You do have meaningful exposure to alternative investments, both private equity and private real estate in particular. Those asset classes have served you well. We think you need those enhanced returns from those asset classes to be able to generate the returns that are expected, and we believe that you can withstand the illiquidity by investing in those asset classes. You do have what we consider to be sufficient flexibility in your program by means of the Opportunity Fund. The recommendation that we do have today is to increase the exposure to the Opportunity Fund from a maximum of 8% to a maximum of 10%. More on that in just a few minutes. We do believe you have good downside protection and inflationary protection, and as I mentioned earlier, you have adequate liquidity. So with that, let's skip forward. And if there's anything that Katie and I skip in the discussion, please do stop us and raise your hand, and we'll be happy to hit something that comes to mind or is of interest to you. But I'd like to pause now and turn it over to Katie and ask you to turn to slide 12.
12.
Well, I was going to go all the way to 12, and this is basically where the rubber meets the road and shows your asset allocation and expected return. Go ahead, Katie.
Perfect. As Steve alluded to, these are the interesting numbers that you all want to see. So what we're showing here is that long-term policy that Steve mentioned that you all had set through the asset liability study. And we're showing our expected returns and expected risk on the right-hand side. And these are looking over long-term time periods. So over a 30-year period, what are these expectations? And so you can see some modest growth. You can see the largest expected returns are coming from the alternative asset classes, private equity and infrastructure. And if you go all the way to the bottom, what you can see is when we aggregate all of this information together, we are expecting a long-term return of 6.7% and a volatility or a risk number of 11.7%. And so we also included where were we last year, what has changed. And so you can see last year at this time, we had expectations of a slightly higher return, 0.9%. What's driving the lower expected return over the past year is coming from yield. As you all are likely very aware, in the first quarter, with all the volatility, the Fed funds rate is now back to 0.25. The yield curve has dropped across the curve, indicating obviously lower yield and expectations of lower yield going forward. And so if you look at the expected return for fixed income in that table, a meager 1.8%. Initial yields and cash return are also a part of a building block for some of our other asset classes as well. And so that's really what has driven an expectation, the modestly lower expected return. But what does this tell us? This tells us that we are expecting some modest growth. We are on the heels of an 11-year bull market, and so we don't expect to see long-term annualized returns of 8 and 9% that we have seen when we look at the past few quarterly returns. However, as Steve mentioned, the 6.7% is above the actuarial assumed rate of return. And so we are expecting you all to meet that objective and that the program is diversified and structured well to weather short-term and long-term volatility over the long-term period. I'm going to switch over to asset allocation, but are there any questions on our capital market assumptions? We have included some details in here that you all can peruse, but any questions at this point?
Yes, it's George Kenny. So I see that you've got an expected return of 6.7 with a standard deviation of just under 12. It gives us a Sharpe ratio of about 0.47. That's based on the allocations that are targeted here. Is that how you did it when you combined? You made a portfolio of those allocations, and that's what you get?
That's correct. These reflect your SDCERS policy portfolio.
Right. So my question is, did you run a mean variance optimization to see if there was a better mix of the 10 assets here that would give us a higher return with a better Sharpe ratio and lower risk? I know that we have policy which says we need to have 18% of U.S. equities, et cetera, and that determines what we're seeing here. But if you ran an MVO, mean variance optimization, could you do better? Could we do?
So we didn't include mean variance optimization in the analysis. We did run that with our renewed assumptions, and there's really no effective change in the mix between the assets that you have here that would generate a sufficiently different differentiated Sharpe ratio or higher returns or lower risk. So you are on the, quote, efficient frontier. We do put constraints, though, George, as we've talked about at the investment committee level in the past. We do put constraints on when we do run efficient frontiers. We constrain things like illiquid assets, knowing that we can't get in and out of those quickly enough.
Thank you.
But this remains an efficient portfolio. I appreciate that question.
Thank you.
Are there any other questions on capital market assumptions? Great.
Katie, actually, I do have one question. This is Karina. As of what date are these expected returns taken? Was that pre or post the coronavirus?
So post, great question. These are using what we label as our second quarter of 2020 capital market assumptions, and the starting point are the valuations at the end of the first quarter. So it will, that's our starting point for these.
Thank you.
All right, if we want to jump ahead to page 14, I'll quickly cover, some of this is slightly redundant, but part of the asset allocation review, what I did want to highlight here is, again, what you're looking at is the long-term policy, and highlight the 78% allocation to return-seeking assets and the 22% allocation to risk-reducing assets that Steve had mentioned at the forefront of this conversation. And what I want to point out here is, first, the breadth of the exposure that the portfolio has, how well diversified that return-seeking portfolio is, and that each asset class has a distinct role in the portfolio. And that is what we look at when we do these asset allocation reviews and our structure reviews, to ensure that the intended role for these asset classes is what they're generating and what we would expect them to generate. If you flip ahead to the next page, some of the similar data that we just saw, but what I want to point out here is that when we use our capital market assumptions and project forward, we're not just projecting forward an expected return, which you've likely heard us say before. If there's one thing we know, we likely know that you will not earn exactly 6.7% annualized over the next 30 years. But we can be reasonably confident that in these range of expected returns. And that's important because we're factoring in a number of different market environments and market scenarios when we're generating these expectations, including ones like we experienced in the year-to-date period of 2020. And so when we're generating this asset allocation, we are not only looking to generate a long-term portfolio that is intended to provide the necessary growth in relation to the liabilities, but that's also able to weather both short and medium-term volatility, such as we have experienced. And there are certain aspects in your program that have been deliberately designed to do that. For instance, the dedicated fixed income allocation, and we'll talk a little bit more about that in the structure review. The very well diversified return-seeking portfolio that you have, not only across the public equities and the global exposure that you all have created there, but as well as across other alternative asset classes. The Opportunity Fund, which provides obviously flexibility, but also the ability to get into some investments that can provide attractive risk-adjusted returns and diversify some of the other risks in the portfolio. And then, as Steve mentioned, ensuring that there is appropriate liquidity, not only through the liquid asset classes, but through passive management and ensuring that the use of alternatives lines up with the liquidity needs of the portfolio. And so before I hand it over to Steve, just very quickly on page 16, we did run backwards looking, but just highlights that the diversified portfolio has provided the overall portfolio. Here what you're looking at is how the SDCERS portfolio has performed in stressed periods. And you can see that diversification and the asset allocation has helped preserve the portfolio in some very severe stressed markets.
Okay, thanks, Katie. Let's look at the experience from the last, well, multiple sets of years. Let's go to the next slide, slide 17. So our expected return is 6.6%, and we wanted to ask the question, how have we actually done over time? And so what we have here is, in the chart, is rolling 10-year returns going back to 1994 through the present time. And you can see, essentially, it's been a pretty bumpy ride. But what's important to note, the blue line, which is your actuarial assumed rate of return and how that has changed over time, most recently, and you'll be talking about this with your actuary in a few minutes when you do the experience study, your actuarial assumed rate of return is 6.5%. How has this program done relative to that over time? On average, it's done quite well, returning 8.4% over this time period on a 10-year annualized basis. But there are periods of time where it's been significantly below that. And you can see that during the 2008-2009 time period, and you can see the periods of it significantly higher than that as well. Most recently, obviously, you see the drawdown that we've experienced in the first quarter, and yet still your long-term returns, your rolling 10-year return is still sufficiently above your actuarial assumed rate of return. So this is just another way to look at some of the volatility that Katie illustrated on some of the previous slides. There's a standard deviation or a volatility number associated with your expected return. You can see that borne out in your actual returns given the volatility of that green line over time. Let's go ahead and go to the next slide. And we'll kind of round out our thinking on asset allocation and come to the recommendations. So there's a handful of things that we always want to look at when we're working with your investment team and when we're working with your investment committee and then ultimately presenting to the board when we think about asset allocation. And those are shown on the far left-hand side. And we summarize the role of each of these different areas of focus, and then how is it that we address these concerns, the role, or the issues that are presented in the areas of focus. I won't read every number here or every point here, but the important thing to note is that your program does remain broadly diversified. You have 6 major and commonly used asset classes, including stocks, bonds, real estate, private equity, and elements of alternatives. Your alpha source, alpha means returns from active management. You have elements of active management woven into your program. You tend to take a fair amount of that active risk with your alternative investments. That's by design. That's where most of your return enhancement has come from over the last 10 years, is your private equity and your private real estate programs. There's elements of inflation protection within the program. You have real estate, you have what's called TIPS or Treasury inflation protected securities within your fixed income portfolio, and we have shorter duration fixed income as well. It's a little bit more of a conservative posture. There's flexibility in the program by way of your opportunistic allocation, and we'll be getting to that specific recommendation in just a minute. We do believe you have ample liquidity. Roughly 70% of your assets can be traded in a single day with sufficient liquidity, so that we do believe you have adequate liquidity to be able to make benefit payments. There's elements of downside protection. We saw that in practice during the first quarter. As extreme as the returns were in the first quarter, your program held up reasonably well with the asset allocation that you had in place. Your fixed income did as we would expect. It did quite well. And there were some elements of protection within your opportunity fund. And then last but not least, but really important, is your program is efficient, that there's simplicity and it's rather straightforward in its nature. We don't find that you need a remarkably complex asset allocation or program structure to be able to meet your long-term policy needs. So I'll pause there and see if you have any general questions. If not, we will wrap up with the recommendation.
I have a question.
Yes.
Who is that?
It's Almas, sorry.
Oh, hi, Almas.
Hey. The slide that shows the average 10-year return, I think it's the previous one.
Yeah, 17. There we go.
Yeah, I'm not sure if I understand fully the calculation of how you get there, because I guess I'm looking at the year of roughly December 08 through December of 17 or September of 18. Is that 10-year period 8.4%? Because I just don't see anything going above that. So just make sure I understand the calculation, and if there's been a 10-year period where it's not been, and what's been sort of the worst 10-year period.
Yeah, the worst 10-year period has been 10 years ending December 31st, 2008. That was kind of the nadir of the market, the financial downturn. And you can see that is roughly 4%. So when we look backwards from December 31st, 2008, look backward 10 years, your return at that point in time on the total fund was roughly 4%.
Oh, I get it. Sorry. Yeah. Okay.
That was the low that it's been. And we were all working together at that point in time. And I will tell you that was a very difficult point in time. But then you can see the rally that ensued. You can see that strong upward sloping line over the next multiple cycles. And we just went through the longest single bull market in history.
Okay. Thank you.
Good question. Okay. Any other questions or comments? George?
The question. So it's fortuitous that the efficient frontier or the optimum portfolio beats our requirement by 200 basis points. I'm sorry, by 0.2%. What would you have done if we're already on the efficient frontier? What would you have done if it hadn't? Let's say that your expected nominal return was 6.3% or 6.3%.
So we've been there with this board and with this investment program. There's been periods of time where the expected return wasn't sufficient to meet your actuarial rate, in part because your actuarial rates were rather high. Those are hard conversations because we know there's only a few levers that we can push to change that. And the formula is fairly simple. And Gene can remind you of this formula. I like his tank that he shows, that it's contributions in, benefit payments out, and investment returns. Those are the things that create the equilibrium or the balance in the portfolio. And if the investment returns aren't sufficient to meet your expectation, then there's contributions, and that's a very difficult conversation, obviously, to have with a plan sponsor. It seems like you have a very strong and a very healthy relationship with your plan sponsor, and they've been able to make the contributions that are needed over time. And then benefit payments, and that's a whole different ball of wax that's also outside of the control of all of us. So the difficult conversation is what could be done differently with contributions, and then the difficult conversation might be, are there other things, other risks that we are willing to take as a board with respect to investments? Do we want to lever up the portfolio and increase the level of risk? Do we want more in private assets? And this is why we do the asset liability study. There's obviously trade-offs between being able to accepting those additional risks and the possibility of experiencing draconian downside experiences. So the good news is you're not there, that you have sufficient contributions and you have sufficient expected returns from your asset allocation as it exists today, but that always hasn't been the case.
Does your suggestion to increase the opportunity fund from 8 to 10% have any bearing on this discussion?
It doesn't have a bearing on your specific question on do we have sufficient returns. We think you have sufficient returns. The recommendation to increase the opportunity fund is part and parcel that we've just seen some interesting things. This board in its last meeting approved a $40 million allocation to a TALF investment program, which we think will accrue great benefits to the trust fund over time. We just want to make sure that there's ample flexibility. There's tools in the toolbox, if you will, to take advantage of other opportunities that might present themselves in the near future. That's not to say that there's anything on the horizon. We're just looking for that flexibility should the need arise.
Thank you.
Thank you for the questions. Let's go forward, please, to, I think it's slide 20. And we kind of hit on a lot of this at the outset, that we do believe that there's ample diversification across your major asset classes. We've talked about the exposure to alternatives and the importance of those. We've talked about the exposure of having flexibility to look for different opportunistic investments. And at the outset, I also referenced that over the last 10 years since we've been working with you, we've actually made some very meaningful changes to your asset allocation. The last 4 or 5 years, we really haven't, because we think you have a good policy allocation, a good mix between stocks, bonds, private equity, and real estate, that it doesn't warrant additional significant change. The recommendation that we do have before you is to increase your opportunity fund from 8 to 10 as a max. And I do want to draw your attention to 2 other recommendations that we've made with the board in the past year that we're pulling off the table. And Katie, I'm going to turn this back to you. If we can go to slide 20. There were 2 things that you may recall we talked about. Whoops, slide 21, I'm sorry. Thank you. Katie will hit some of the quick highlights. I'll hit a highlight, and Katie can go just a little bit deeper in that. But in the past, we had thought that it might be appropriate for you to consider a slight reduction in your private equity program. We don't think that that's needed at this point in time. We also wanted to re-examine elements of fixed income. Katie, do you want to fill in some of the gaps on those 2 and then bring it in for a landing with the recommendation to the Opportunity Fund, if you could?
Yeah, absolutely. So as Steve mentioned, we wanted to close the loop on some of these things that we brought up last year. Private equity is modestly overweight its policy, and we considered bringing that allocation down to modestly reduce volatility and improve liquidity. However, revisiting this, given modest expected returns, we think the portfolio could benefit from the enhanced returns expected from private equity. And we continue to think that the liquidity profile of the portfolio can withstand having the 10% allocation to private equity. What the investment team has been able to do, though, was they did successfully close on approximately $72 million of secondary sales to bring the actual allocation closer to policy. So we will continue to look at this, but as Steve mentioned, this is something that we don't think there needs to be action at this time. And somewhat of a similar story with the fixed income consideration. So we were looking at possibly expanding the emerging market debt allocation to a multi-asset credit, or MAC. This is a mandate that can tactically shift between high yield, bank loans, emerging market debt, basically a variety of return-seeking fixed income. And at the time last year, it didn't make sense to do this given where markets were. And we've come to a similar conclusion when we reviewed this over the past year, that now is not the best time to be doing this. But we also looked at the long-term overall impact on the portfolio's risk return profile, and it has a modest impact. So while we think diversifying that exposure continues may be beneficial, right now we don't believe it's the time to do that. And that leads me to the third consideration that we brought up in our recommendation today. And I'll actually have you jump to page 23. And for the benefit of the full board, a quick reminder on the Opportunity Fund's role in the portfolio and how it's structured. And so it's structured, as Steve mentioned, as an allowable range. So different from other asset classes where there's a target allocation, this asset class has an allowable range of 0% to a maximum of 8%. And the rationale for that is that we only want to fund this if there are investments that will provide attractive risk-adjusted returns. So either enhancing returns or reducing the risk relative to the policy portfolio. And so the individual investments underneath may do one or the other. Ideally, they do both by generating a higher return at a lower level of risk. But when we look at the aggregate portfolio, that's the goal. So there's a very high bar for what goes into this portfolio. Some of the things that would fit, and going back to the role of this, is to provide you all with the flexibility to get access to these respective investments. And a perfect example is the TALF investment that you all just approved at the last or the special board meeting. That was something that is truly opportunistic. It is something that was very timely and is going to be short-lived. But without having this allocation, it would be difficult to find a place for this in the portfolio. Other type of investments are those that may span across traditional asset classes. They may not fit neatly within traditional equities or bonds or real estate. And so the Opportunity Fund provides a house for those as well. And an example of that is the managed futures allocations that you can see here in the pie chart. So recommendation right now is to increase the allowable allocation from 8% to 10%. And at the bottom there, you can see the progression of the portfolio build out over time. It has been very well, methodically and thought out. Each investment, we have gone through a very diligent process in ensuring that it will, that we have confidence that it will add value to the program. And you can see that in the top chart there. This is performance through March, and though returns are muted given what we just experienced in the first quarter, since inception, the portfolio has earned a 5.8% return, which is 300 basis points above the benchmark. Benchmark being the opportunity cost of capital, which is the 78% global equities, 22% fixed income, the policy portfolio. If you flip ahead to the next page, possibly a better picture of how the Opportunity Fund has performed is looking at it on a risk return chart. And so what you can see is that the blue dot shows the total Opportunity Fund's performance over the past 5 years. And then the orange square is the benchmark. And what this tells us is that the fund has been successful over this time to get a higher return at a lower level of risk. And so why we think it makes sense today to increase the flexibility for you all to allocate more to this is that given everything that has happened, we think that there will be some attractive opportunities over the next 6 to 18 months that you all may be able to take advantage of. Right now, the portfolio is bumping up against that 8% max. We are aware and we will factor in that some of the investments that are currently in your Opportunity Fund will be returning capital. Some are closed end and will be drawing down. So we'll take that into consideration. And there's no certainty that we'll ever get to a 10% max given the capital that's coming back, or if the investments are not meeting that high bar that we have for this allocation. But we do think that having that flexibility provides the opportunity for you all to take advantage of some things that we think may be attractive. And then my last comment here is that this is an allocation that we think can provide some value add. Again, we've talked about some more modest expected returns, and here is an area where active management can help enhance the return of a portfolio if the opportunities arise. So I'll pause there to see if there are any questions or comments.
Katie, this is Karina. It's not a completely unrelated question, I think, but on the TCW TAL fund, do we know if that manager has participated in the TAL auctions to date?
I believe, and
Yes.
Go ahead.
Yeah, Karina, yeah, we've had one capital call for $4 million so far.
So I think we're done with our asset allocation presentation. There is a recommendation to increase the opportunity exposure from 8 to 10. If that is approved, nothing changes the next day. There's no redistribution of assets or hiring or selecting an investment manager. All that's doing is giving your team and Aon flexibility to bring you things that you would ultimately approve down the road.
Okay. Thank you for that excellent presentation. Are there any other questions or comments from the board? Hearing none, can you, by saying your name, make a motion in a second?
Charlie makes the motion.
I will second Carl's motion.
Sorry, who did the first one? First motion was that you, Charlie?
Yes, it was.
And Karina second?
Yes.
Okay.
Okay, thank you. Please call the roll.
Ms. Broad,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny, Mr. Kenny,
Yes.
Mr. Maggi,
Yes.
Mr. McBride,
Yes.
Mr. Provost,
Yes.
Ms. Spoon,
Yes.
Mr. Udries,
Yes.
Mr. Wallace,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 13-0.
Okay, thank you. And again, thank you for all of the work and thought and excellent presentation by Ann. And part two of our annual discussion regarding the portfolio, we're now going to turn to Katie to talk about portfolios, and I think Ashley as well, portfolio structure and implementation.
Thank you, Carol. If we flip ahead to page 6, portfolio structures. What we're discussing here is we have this asset allocation that we just talked about, but how do we implement that to ensure that the intended roles are being carried out? And so we're discussing things such as where to take active management, where to use passive management, the number and the types of active or of managers to be used, ensuring that there are no unintended biases in the portfolio. And so there is, if you've had a chance to poke through, this is an extremely long deck. There's a lot of analysis that went through this. But what we are planning to do is to hit the highlights. We want to hit public equities quickly because there has been a lot of work that the investment committee and the investment team and Ann has done. We do have a recommendation on fixed income that we'll hit, and then maybe we'll take a pulse of the board to see if we want to hit high level the other asset classes. But similar to asset allocation, once this is set, we don't anticipate major changes. There will be some tweaks and that are made to help marginally improve the overall structure. But the SDCERS board has done a tremendous amount of work over the past 10 years. And so where the portfolio is today, we think is in a very good spot. And some of those highlights is that the portfolio has taken active risk very deliberately. There's a meaningful allocation to alternatives where we think that risk will be most heavily rewarded. Steve mentioned efficiency is another important part of not only the asset allocation, but of the investment structure, ensuring that low-cost passive mandates are being used and where fees for active management are there's high conviction that those will be rewarded. We use an active risk budget to monitor and make sure that the risks and rewards are aligned. And then obviously looking at fees and costs over the entire program. If you flip ahead, before I pass it over to Ashley to hit the highlights on fixed income, I'm going to flip ahead one page to page 7. Just want to remind the committee, this is a slide and some comments that we touch on every year. And these are the key tenets that hold true when we are setting structure and when we are evaluating the portfolio. And so the highlights of these are, one is to gain exposure to the broad opportunity set and to ensure that there are no unintended biases. One of the things that the SDCERS program has had was a small cap bias within the U.S. equity portfolio. That was a known bias and something that we quantitatively measured and monitored over time. And you may recall last year the decision was made that didn't make sense anymore to have. And so we are eliminating that. And Ashley will touch on that briefly. Pay little for beta. Make sure that the active management that is being used is there and is being effective, and that gaining exposure to the broad market is being done so through low-cost passive management. And we think the best way to do this is to identify active managers based on their skills, provide them a broad mandate, move away from some of that style box approach, and allow skilled managers the flexibility across broader mandates to add value. And so that's why we use a lot of active management within global equities, providing them the broadest opportunity set to move between different sectors and styles to add value above the benchmark. I mentioned the active risk budget. Again, this is a tool that you all use to ensure that the risks being taken align with the expected reward. And then again, we list here last, but certainly not least, is to be cognizant of the fees and where they're being spent. Higher fees don't always translate into higher return, higher value add. So I'll turn it over. I'll give a heads up. We will be jumping to through a lot of slides. So please do, if anything did catch your eye you want us to cover, we plan to hit just the highlights and then land on the fixed income recommendation. And then again, we can take the pulse of the board if you'd like to hit the other asset classes. Ashley, I'll turn it over to you.
I have a question, please. Can you talk about how you think your approach to advising us on liquid versus less liquid assets, and whether the liquidity or illiquidity premiums are, if you will, worth the trouble?
Yeah, great question. So that initial discussion typically happens at the asset liability study at the very high level. What we want to first and foremost consider are the benefit payments and the net cash outflows that are needed, and to make sure that there is enough liquidity in the portfolio to make those payments, and to consider that across a wide variety of economic scenarios. So to see what types of scenarios would put pressure on the portfolio in being able to make those. And so the initial evaluation is set at policy. And we did that in 2018, and there's roughly about 30 to 32% of this portfolio per policy is allocated to what we would consider as illiquid or quasi-illiquid asset classes or alternatives. And through the asset liability study and the asset allocation work, we think that's a comfortable level for you all and have stressed that. But then in terms of, is taking that liquidity risk worth it? It's a great question. And we have looked at the expected returns of these additional asset classes, looked at the diversification that we think that they provide to equities. And it's not just a quantitative number that we're looking at. There's other things to consider, such as the cost, the additional resources for monitoring, for being able to source. A large part of being comfortable and making it worth investing in alternatives is being able to find managers that are skilled and that can add value above that high bar of it being able to be traditional, more liquid asset classes. And so we have our team, and we try and bake those expectations into some of those expectations into our capital market assumptions, and that'll help identify some of those trade-offs on extra return with added risk, and then overlay that qualitative factor of resources and monitoring and ability to identify those private markets. I don't know, Steve or Ashley, if there's anything you wanted to add.
Yeah, I'll jump in. So just to put a fine point on it, your real estate investments over the last 10 years through the first quarter generated a return of 11.2%. Your benchmark 10.1. Private equity generated a return of 18.4. Your benchmark 11.3. And then just by way of comparison, U.S. equities generated a return of 8.8. So in both cases, private equity and real estate generated returns over that 10-year period of time significantly ahead of traditional equities, and therefore significantly ahead of your total fund.
What was the end date of those numbers?
That was the first quarter of 2020, our most recent performance report.
Fair to say that the public equities were at a very low place, and the private assets probably have some issues coming forward that are going to trickle out slowly over time.
Yeah, I think there'll be some mark-to-market noise or downward pressure, but even with that, you're 10 percentage points ahead on your private equity relative to your public equity. That's a huge premium to be paid. Your private equity program has done exceptionally well, broadly speaking, both in terms of the time that it was implemented, but the types and the sourcing of investment opportunities that your advisors have provided you. You all and they all have done truly a terrific job.
Absolutely, thank you.
But Cliff, your question is a good one because the premium has been coming in. We've seen more money flowing into private equity and private real estate over the last decade, and therefore the expectations would be that some of those return premiums would moderate. What we like to see is about 200 to 300 basis points of illiquidity premium over time, and you've achieved that. We do think that there's risk of it being less than that on a go-forward basis. Katie, I'll turn it back to you.
Appreciate it.
I have a quick question, if I could. So is the idea here to migrate the more intermediate fixed income manager core mandates to core plus mandates and hold off on some of these multi-sector credit funds, and is maybe doing so advantageous from a fee stance?
Yeah, good question. So the idea with the intermediate fixed income is not to move all the way to a core plus. Right now, where the fixed income portfolio stands, it's a very core portfolio, and that is very intentional to be high quality, a very limited amount of out of benchmark exposure. The recommendation, what we are recommending, is modestly flexing those guidelines and increasing the active management within fixed income, because we think that there are some opportunities for your fixed income managers to take advantage, but the flexing of the guidelines, we don't expect to modestly change the overall risk profile. The role of the fixed income portfolio is still to be that protection bucket liquidity provider. And so the recommendation is not to take it all the way to core plus, but to be somewhere in the middle. And so it's not to replace what we were considering as a multi-asset credit or a return-seeking fixed income. We want to keep those decisions separate and distinct. We want to keep fixed income as a protection bucket, and then consider a return-seeking portfolio or diversifying the emerging market debt as part of a diversifier for the return-seeking bucket.
Thank you.
So maybe in the interest of time, Ashley, do you want to hit the very high level what we've been doing with public equity, and then we can actually get more details into the fixed income recommendation?
Yep. Okay. Turn ahead to page 19. I did just want to briefly provide some comments on the U.S. equity structure once we get there.
What slide, Ashley?
You cut out. I couldn't hear what page. Thank you.
Right.
No problem. So the U.S. equity structure is something that we've been working closely with the investment team over the past year to really do a deep dive to ensure that the structure remains sound and appropriate for the overall portfolio and still aligns with our best thinking. How it started, Katie mentioned earlier that there was an intentional small cap bias to this asset class, which we've been monitoring over the past few years, and we did determine last year to reduce this small cap bias and ultimately eliminate it altogether. So this prompted us to take a step back and look at the total portfolio as a whole to see what kind of changes we think should be made, if any. And what we have is a new portfolio, which will be implemented shortly, which you can see on the upper right-hand pie chart on this page. A little bit simpler than the current portfolio. We're reducing active managers from 3 to 2, and this will allow each active manager to contribute more to the overall active risk of the U.S. equity portfolio. Simplifying the passive exposure a bit as well. You'll see there's a large portion that's going to be with the BlackRock Dow Jones Total Market Index. This is also the index that's used as the benchmark for the overall asset class. So this will help minimize tracking error going forward. And yesterday, a new manager was approved, the William Blair Mid Cap Core Equity Fund. This is an active fundamental bottom-up manager that will invest in both small and mid-cap stocks, and that will have a 6% allocation. The Allianz convertible strategy will remain in the portfolio to provide diversification. And then finally, there is still a small allocation within the BlackRock S&P 500 index. This was a result from the Allianz managed future or Allianz structured alpha assets. They're currently sitting in this index, and we are working with the team to identify a potential replacement fund. So more to come there. But really overall, we thought This portfolio represents our best thinking in U.S. equity markets. It is very tough for active managers to outperform, particularly in the large cap space. We focused on areas where we do feel that the managers have the greatest opportunity to add value, and this is more in the small and mid cap space, and then the convertible strategy, which is a bit of a differentiator versus the broad U.S. stock market. A couple of changes that you'll see going forward. The policy will remain style neutral and will also be size neutral as well relative to the market. Additionally, the passive exposure, at least temporarily, will increase a bit to 80% of the overall portfolio. Again, this aligns with our best thinking. And the investment management fees will go from about 16 basis points to 13 basis points as that passive exposure increases as well. So that will drive down costs. And then just the last piece that I'll comment on is tracking error. Historically, the expected tracking error was about 1.4%, and about 2/3 of that has been accounted for by the small cap bias. So once this is removed, most of the projected tracking error will result actually from the Allianz convertible strategy, as this is most differentiated versus the benchmark. And the active risk will slightly decline given the higher passive equity exposure. Any questions on the changes that will be occurring with this portfolio? Great. I will just briefly touch on the next couple, and then we'll go to fixed income. So if we can go ahead to page 22, this shows the non-U.S. equity portfolio. Again, this is a broadly diversified portfolio. It does align with our best thinking. The long-term target is 15%. Where we believe that active management has the highest probability of success is in international small cap space, where these markets are not widely covered, and it does take a lot of skill to uncover value in these areas. Additionally, we believe emerging markets are a great source for managers to add value as well. The majority of the active management is taking place in those two areas, and about 60% of the portfolio is also passively managed, which keeps the overall cost of the portfolio down at 33 basis points. But overall, we're not recommending any changes to this portfolio. We are going to be taking a step back and reviewing this one as well, similar to what we did with the U.S. equity portfolio, just to ensure that the structure remains sound and still aligns with our best thinking. Potentially more to come on that over the coming year. And then finally, if we move to slide 25, this is the global equity portfolio. This is a newer allocation, been around a few years. The long-term target's a little bit lower at 8%. There are currently 4 active managers in this space, about equally weighted. They do all have different unique approaches. There's a couple value-oriented managers, a manager that focuses on high-quality growth, and a quantitative manager as well. We do believe in active management in the global equity space. We believe that there is most opportunity for managers to add value the larger their opportunity sets are. So therefore, this portfolio is 100% actively managed. And you can see at the bottom of the page, the projected tracking error is 1.7%. This is higher than both U.S. and non-U.S., given the fact that it is 100% actively managed. But again, from a policy perspective, it's style size neutral. There will be active tilts from the active management of the portfolio. Currently, these managers are slightly underweight to U.S. and overweight to emerging markets, but these generally don't persist, and they'll take advantage of opportunities given how the market environment changes. So no recommended changes here either. Any questions on equity before we get back to fixed income? Yeah, Ashley, this is Karina. I have a quick question. Can you go back to the U.S. equity manager lineup? And I just wanted to see, we do continue to retain Fisher investments there, but it's a reduced allocation. Can we comment on that? So Fisher will actually be fully removed from the portfolio. So currently, this is as of the end of March. Fisher had about a 5% allocation. And going forward, that will be replaced. So Fisher and DFA are dedicated small cap managers. They also have a little bit of a value bias. So we are going to replace that with the William Blair mid cap manager, which is more core. Okay, thank you very much.
Any other questions on equity, or should we move to slide 30 and get to the recommendation? Great. So on slide 30, here's a snapshot of the fixed income portfolio. And what we noted before is that this is a very high quality core allocation with the intention of providing that downside protection, truly an equity diversifier, and providing liquidity for the portfolio. Currently, it's 4% allocated to a passive investment, and then the remaining 56% is split between TCW and PIMCO, the two active managers. The tracking error is fairly low, about 40 basis points, and notably, been very distinctively, I believe in 2014 or earlier than that actually, the guidelines for the active managers were very intentionally modified to ensure that this was a core portfolio. So there is a quality requirement that they maintain. There are specific limits to out-of-benchmark exposures such as high yield, emerging market debt, non-U.S. bonds, and limits to below investment grade. And again, this was to ensure that the portfolio was providing that role that it was intended to. If you flip ahead to page 31, you can see that the result of this is a portfolio that is very similar to the benchmark, very high quality and very, very low exposure to below investment grade. At the end of the quarter, there's about 2.6% allocated to below investment grade, which was within the allowable guidelines that have been set. Now, if you flip ahead to page 33, as we talked about a little bit, the market volatility that we experienced in the first quarter, we think has provided an opportunity for SDCERS to, at the margin, improve the risk-adjusted returns within this portfolio. We saw credit spreads blow out 2, 3, 4 times what they were at the end of 2019. They have come back somewhat where they are today, but we do still think there are opportunities. And your managers, both TCW and PIMCO, are very skilled and have other investment strategies that have proven they're able to take advantage of some of these situations. Some things that we're talking about are some investors have been forced sellers of securities to provide liquidity, and that provides an opportunity for managers that can pick those up and hold on to those, and those can be very attractive securities to hold. Another area of the fixed income market are what we would call fallen angels, and these are bonds that have been originally issued as investment grade, but have then such fallen to below investment grade, but that still have fundamentally sound characteristics. And there's a lot of data that these so-called fallen angels have performed very well and present a very attractive risk-adjusted return. And so what we're recommending is twofold. One is to modestly relax some of these guideline restrictions, and we'll talk about that. We're not looking to change this from a core to a return-seeking or a core plus portfolio, but to allow the managers some modestly more flexibility so that they can take advantage of some of the opportunities that are out there. And then the second recommendation is to modestly increase the exposure to active management. Fixed income generally is a place where we think active managers can add value. And so particularly in this type of environment, we're recommending increasing the active exposure from roughly 55% to 70%. And if you flip ahead to page 34, here what we're showing is the current at the top, how the current portfolio is allocated. So roughly 44% to the passive index fund, and then the split between the active managers. We're recommending reducing passive exposure to 30, and then equally weighting the allocation to TCW and PIMCO to provide more active management into the portfolio. Then what we did at the bottom was we highlighted some key characteristics and some of the key guidelines that had been discussed with the managers and with the investment team that we think will allow them to provide some return. And so what you can see is the increase in the active allocation, an expected increase in active risk, 35 to 47. So an increase which is a result of both and also applying a little bit more out of benchmark exposure. And then what we did was looked at what was the allowable allocation of these that we're talking about. So previously, the total fixed income portfolio we're suggesting increasing that 7%. And then similar with emerging market debt, previously it was at 1%. We're recommending an increase to 5.6%. To non-agency mortgage-backed securities, 2.5% was the previous allowable maximum. We're suggesting increasing that to 7%. And then the maximum below investment grade, which will capture anything that is below investment grade. So will be the ultimate cap. Previously was 3.5%. We're recommending increasing to 7%. This will.
I have a couple of questions. If you finish, I'm not certain.
Oh yeah, please.
So, having worked in the non-investment grade business for a number of years, is the allocation flexibility that you're proposing to do anything in below investment grade, or just fallen angel, increasing the capacity to do fallen angels or split rated bonds?
It would be the manager's discretion. So below investment grade could be other, those were just some examples, but below investment grade could be anything below investment.
So it could be down to triple Cs. It isn't just double Bs or single Bs.
Well, so that's a good point. So we are still maintaining an average quality for the overall portfolio. Would still have to be A+, we have that on the next page, an A+ rating. So for an individual security, there's a potential. There's also a potential for non-rated. Some securities, when we spoke with your two active managers, have noted securities that have not been re-rated by agencies in quite some time. Mm-hmm. But we do have that average credit quality for the overall portfolio still at an A+, because we want this still to be a high quality core allocation.
That sounds very reasonable to me, I would say. Are these recommendations being made with an eye towards the current environment? Carol earlier alluded to the possibility that we're going to see more, if you will, downgrades, more distress potential in various sectors. And in light of that, this proposed greater flexibility would give those managers opportunities to be very selective and for us to get the benefits of their research and security selection talent to bring into the portfolio without changing that average credit quality.
Yeah, that's correct. That was the impetus to this discussion, and we spoke with both managers and the investment team and think that it is a good opportunity here. That being said, though, we will be revisiting this on an annual basis to make sure that this additional flexibility continues to make sense and that it's being implemented as we would expect from your active managers.
That's great. Thank you very much.
You're welcome.
So I think with that, I think we're done with our formal remarks on structure. This is a good page to land on as it relates to the guideline changes in fixed income and the structural changes that Katie and Ashley walked us through. So we will pause there. I do believe there is a motion prepared for this.
Right. And, any further discussion?
This is Karina. I think I would be in favor. I would actually like to make the motion. I think it's a great environment to offer managers a bit more flexibility, and I'm certainly in favor of this.
And this is Cliff Jerson. I would second that.
Thank you. Cynthia, please call the roll.
Ms. Bright,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hawquist,
Aye.
Mr. Kenny,
Yes.
Mr. Maggi, Mr. McBride,
Yes.
Mr. Provost, Mr. Provost, I'll come back to you. Ms. Boone,
Yes.
Mr. Udries,
Yes.
Mr. Wallace,
Yes.
Mr. Shearson,
Aye.
Mr. Kaufman,
Yes.
Mr. Provost.
Yes.
All votes are in, and the motion passes 13-0.
Great, thank you. Many thanks to Aon for all this excellent work and a very sound recommendation. And we look forward to talking again about this next year with you. But thanks so much. Okay, next we're turning to our actuarial experience study, and Marcel is going to introduce this topic.
Good morning. Good to see everybody this morning. So this is our experience study that we do once every 3 years. In the past, we had done this every 5 years, and you may recall that last year the board voted to change the policy to do a triennial review in trying to get caught up. It has been 4 years since our last experience study. The last one was data as of 6/30/15. This one will cover July 1st, 15 through June 30, 19. And we do have our actuaries here with us to walk you through. As a reminder, this looks at all of the assumptions that are used to determine the liabilities and also the plan sponsors' contributions, and they will be determining that for the next 3 years. So with that, I'd like to introduce Jean Kalwarski and Alice Alsberg from Chiron.
Good morning, everyone.
Morning.
So, Marcel, you'll be driving this, right?
Correct. I have the slides.
Okay, so you're on slide 1.
I am on the cover slide, and now I'm on slide 1.
So what we'll be covering today is a reminder of what the board policy is, which I think Marcel just summarized, and then we'll cut right to our recommendations on economic, demographic, and administrative expenses, and then end with the estimated impact on your next valuation. If you've gone through the material, you'll see there's like 40 pages of appendices. Those are all the details that back the recommendations, and we may touch upon some of those as we go through it, but we're first going to cut to the chase with our recommendations. As background, I think Marcel just said, you conduct your experience study every 3 years, and the specific assumptions we study on the economic side are the discount rate, wage inflation, and cost of living increases, and on the demographic side are the people assumptions, mortality, retirement, termination, disability, salary, merit increases. Those are the step or promotional increases as opposed to the wage increases. And this study covers the period for most assumptions from July 1st, 2015 to June 30th, 2019. But in order to get more data, credible data for the mortality and disability, we looked at an entire 9-year period, starting in July 1, 2010. So starting with the economic assumptions, and Marcel, I've already scooted ahead to slide 4. This slide is showing 3 lines. The Aon's 30-year long-term expected return to risk outlook is reported to SDCERS. Although we don't have today's numbers. I think that was 6.7 I heard earlier. But that doesn't change much. As you can see, the discount assumption largely follows Aon's expectation throughout this entire period. And on the risk side, the standard deviation dropped more than 100 basis points. So we have spent the board has spent a lot of time over the past several years in getting the discount rate down to where it's at 6.5, and you're really as low as most, if not all, public sector retirement systems. So on slide 5, we're recommending no change at this time and maintaining the 6.5% discount rate, 3.05 wage inflation, and the 1.9% cost of living adjustment. So unless there's any questions, I'm going to move on to slide 6, which opens the door on the demographic assumptions, mortality, retirement, termination, disability, solid merit increases, and some miscellaneous. And Alice, why don't you take over here?
You're on mute.
Let's see. Okay. Is this better?
Yes.
Yes.
Good morning. Thank you.
All right, Marcel, if you can move on to slide 7, please. And before I get into the process for setting the demographic assumptions, I would like to point out that we as actuaries follow a set of actuarial standards of practice that we as a profession believe are very important for us to maintain our professional standing in all of the work that we do. And there are 2 specific actuarial standards of practice specific to setting assumptions, so setting economic assumptions and demographic assumptions. And we as actuaries are set to use our professional judgment when setting these assumptions, looking at past experience and future expectations in changing or updating any of these assumptions. So for this experience study, knowing that we have the 3 plan sponsors, the city, the port, and the airport, and within each of those plan sponsors, there are the various tiers and membership classes, whether there are general members, they have safety members. Many of the assumptions we studied separately by plan sponsor and by membership class. And mortality and disability, because of the minimal incidence, the lower rate of incidence of these assumptions, of these occurrences, we studied the rate of mortality and rate of disablement in aggregate for all 3 plan sponsors. And looking at each of these assumptions, mortality, retirement, termination, disability, we compare the actual experience versus the assumed experience. And in the appendices of this presentation and when we deliver the final experience study report, you'll see a lot of supporting information on the statistical analysis of this study. And one of the main ratios that we focus on is a ratio called the A/E ratio, actual to expected experience. So in comparing those actual to expected experiences, that helps us determine if we should increase the assumed rate of occurrence or decrease those assumed rates. And when setting those assumptions, we take into consideration external influences, any trends that may be going. For example, mortality improvement is definitely a hot topic and a trend that is considered when setting the mortality assumptions. And based on taking the entire analysis into consideration, we then propose recommended assumptions as needed. Not every assumption gets adjusted every time, because you look at the entire body of assumptions is on a trajectory for the future. And when you're looking at that, hitting the liability, calculating the liability for the future, we don't every 3 years or every 5 years suggest assumptions that will swing that liability radically left or right, but rather maintain a gradual course to reach the cost and make slight adjustments to the assumptions to meet the most current experience. Marcel, if you could move to slide 8, please. So since we have a lot of our information in the appendices, without cluttering this slide, I'll take a little bit of time here to step through what we saw when doing the analysis for each of these assumptions. So service retirements, the variables that are important for service retirement, you focus on the age of participants and the service of participants. So our retirement assumption previously was based on service, member service, and there were bands depending on what age the bucket they were in. But now, based on the more recent study and the pattern of experience that we saw, we've actually decided to update this assumption to be a more age-based assumption with service bands. And looking at the overall experience, there were less retirements than expected for the majority of the plan sponsors and membership groups. And so with less retirements than expected, we propose decreasing those rates of retirement. So a decrease specifically for the city, the airport, and the port general, and then followed by an increase in the retirement rates assumed for the safety for the port. In aggregate, for each of the plan sponsors, Mind you, there are certain ages where the rates, when you look, if you do go into the details of these assumptions in the appendix, there are certain rates which increase, certain rates which decrease, but overall, these trends for retirement returned a decrease in the liability and cost impact. Terminations for the membership group was actually in line with what we saw, counter to what we saw for the retirements. Retirements decreased, which means there was a slight uptick in the actual experience for terminations. We were seeing more terminations at the earlier years of service, and so we proposed increasing the rates of termination for the city and the airport. However, the port did have slightly different experience where we proposed a decrease to their rates. And given the dynamic of each of the demographic groups, for the city and the airport, there was an increase in the actuarial liability, but a decrease in the normal cost, which led to a net decrease. For the port, there was an increase on that cost impact. Moving on to disability retirements, for all three plan sponsors, we studied disability retirements together, and we study a larger time period. So rather than just focusing on the 4 most recent years where the actual counts of disablements was low, we included the data from this set of experience, so this 4 years plus the 5 prior years. So studied a 9-year period to see the disability trend. And we did notice that there was a decrease in the rates of disablement, so we proposed decreasing those rates. And when decreasing the disability rates, that leads to a decrease in cost. Now, the salary merit increases. Salary merit increases, this is definitely a big ticket item for the city plan. Year over year, when we perform the actuarial valuation and we come to you and report on the results in January and February meetings, we've been reporting that the city has been experiencing losses from salary. And so we took a long, hard look and a deep dive into the analysis here to see what factors were causing these losses that were based on salary for the city. And there were 2 elements to these merit increases. So this is setting aside or extrapolating the increases from wage inflation and from any of the contract agreements, and only focusing on the merit increases, so longevity, promotions, and step increases throughout careers. So we did notice a trend of higher merit increases for the city and the port, so we propose increasing those rates. The airport, the actual experience was pretty much in line with expectations, so we do not propose a change to the merit rates themselves for the airport. So increasing those rates, meaning increases in the projected salary merit increase, would increase the liability and cost impact. The next demographic assumption that we recommend a change to is to the safety active industrial deaths. So active deaths, there are plan provisions for deaths which are deemed industrial or duty-related deaths versus non-industrial or non-duty related deaths. Only for the safety membership groups, there's an assumption, the current assumption was that 50% of active deaths were under the industrial death type, whereas actual experience was seeing a lower value in the industrial death, and so we proposed decreasing the assumption to 25% of active industrial deaths are industrial rather than the non-industrial. And last but not least, mortality. So mortality assumption comes in 2 components. There's base mortality tables, and then there's an improvement projection scale that combines with those base tables to capture the entire mortality experience. So overall, as a whole, members are living longer. We are seeing that through the analysis, that members are living longer, and when members are living longer, we project and propose setting lower mortality rates, decreasing those mortality rates. So the Society of Actuaries actually recently, in January of 2019, completed a thorough study of mortality incidents specific to public pension plans. And prior to the release of that study, SDCERS was using CalPERS mortality rates as our base assumption, because that was where SDCERS experience most closely aligned to those tables. But now with the release of these new tables, they're called PUB for public 2010, because that was the central study year. So these PUB 2010 tables were most closely reflected the experience of SDCERS. So we propose moving to these PUB 2010 mortality tables, and those tables are specific to general members and specific to safety members, whether you're healthy, disabled, employed, or already retired. And in addition to the change in base tables, there's also the supporting mortality improvement projection. And I'll actually turn it to Gene, so he's going to step through some slides on mortality improvement and show how that gets coupled with the base table change.
Okay, Marcel, if you go to slide 9. So this is showing the mortality experience since 2013, and these are all losses. And in 13 and 16, they were growing, and in 16, as a result of our experience study, we increased or lowered the rate of mortality, which increased costs. But look what happened after 2016. Continue to get losses that are starting to grow. We would have expected, maybe since we developed the table of 16 that projected mortality 20 years out, we would have expected some gains in the early years, offset by losses in the later years. But from the get-go, we started getting losses. And I want to show you, Marcel, if you can quickly just turn to slide 25 in the appendices. Tell me when you're there. Okay. I'm looking at my own computer here. This is showing 100,000 people born in 1990, 1950, 2000, and 2020. And at what age does that population die at? And you can see in the 1900 births, a lot of preemie deaths, a lot of deaths in the younger ages. And you move to 1950, that hump moves over, and it continues to move over in 2000 and 2020. And the end of life is not really growing that much. It's the fact that there's just more and more people making it to their 80s and 90s and even 100s. That's expected to continue. And so what we're recommending is a projection scale that says each generation, each year, people that come into the plan are going to live longer. And you have what's called a substantially equal requirement for member contributions. Technically, one would think that if each year there's an extension mortality, you have to change those. We don't believe you have to, because we're also recommending, for purposes of substantially equal, that produce a static projection table that is equivalent of this generational improvement. So at this point, Alice is going to talk about the last assumptions, and I'll come back in and talk about the costs. So I think now we're back to
slide 10. Yeah. Right. Okay. So this is a good one. Reduce administrative expense assumption is what we propose, just based on the historical administrative expenses for each of the plan sponsors over the past 5 years. We recommend sticking with a 3-year average and using that 3-year average and assuming that it would increase with a 2.5% inflation year over year. The current assumption for fiscal year 2022, if we were to stick with the prior base assumption that was increased each year with inflation, would put the city's administrative expense assumption at $12.7 million, whereas the proposed assumption based on the actual administrative expenses for the plan we would set it at 11.3 million, and that's a beginning of year value for fiscal year 2022, which is one of the elements of the ADC, of the actuarially determined contribution. For the port, also a slight reduction in that proposed assumption to 710,000, and for the airport authority, just a slight reduction at 370,000 for the administrative expense. And I'll turn it over to Jean on slide 11 to step through the cost impact.
So the actual cost impact isn't going to be known until we do the June 30th, 2020 valuation. But based on the 19 valuation, this is what would have happened. The liability for the city would have increased 2.2%, for the port 2.4%, and for the airport 2.8%. The respective ADC cost impacts are in the section down below that, 6.6 and 7.6 for the plan sponsors. But I can tell you the vast majority, 95% or so, attributable to the mortality assumption. All the other assumptions that Alice went through, retirement decreased and some others increased, but they sort of offset each other. But mortality is what was the large ticket item here.
Jean, can I ask a question?
Yes.
Last time we did this was, 2015? We had a very significant mortality decrease and associated increase of liabilities and costs. Kind of level of magnitude, what is this mortality change?
It's not as nowhere near as large as that one. Alice, do you have?
It's about half. Yes, it's about half the impact as last time, less than half.
Okay. And then what the amortization schedule for this is what?
That's a great question. So it was in the January 2019 board meeting that the board adopted 20 years for assumption changes rather than the prior 30 years. So this is based on a 20-year amortization.
Okay.
And it's important to point out also with this cost impact that each of the plan sponsors will be feeling the effects in terms of an increase to their ADC, but also for the city membership group and the port and the airport PEPRA tiers, the contribution rates for the members will be increasing as well because they pay a share of the normal cost. And when the liabilities increase, there's an impact to the normal cost as well, which means that those contribution rates will increase. So for the city membership, the average increase, this is aggregate for the tiers, is between 1.1 and 1.4%. And for the port and airport PEPRA tiers, it is closer to 0.7% increase on those member contribution rates.
We can go into more detail in any one of the substances if you'd like. This concludes our formal presentation, and as I said earlier, we've got plenty of slides in the appendix if you want to continue on.
Anybody have questions, comments, areas you want to drill down on?
I have a question. This is Almas. So when you look at the estimated cost impact on this slide for, let's use the city as an example, the 24.1 million, you just mentioned the member rates would go up. So is half of that borne by the members and the other half borne by the, how does that work?
This is just the city's cost. Alice quoted, what was it, Alice, at 1.4%, did you say, for the member?
Yes, it's in a range of 1.1 to approximately 1.1 to 1.4 based on the current demographic.
So the plan sponsors pick up the full amount of what you see on this slide.
Got it. Thank you.
Anybody else?
This is Lou Maggi. So the 1.1 to 1.4, depending on the tier, when would that actually be effective for the members? When would they feel that?
So that would be effective July 1st, 2021.
Got it. Thank you.
Okay. Other questions, comments? Okay. Hearing none, Thank you very much for your analysis and your presentation. It was very easy to understand, I think. And with that, we will have please state your name with a motion and a second to approve the actuarial experience study.
Hossie moves.
Lou Maggio, second.
Thank you. And Cynthia, please call the roll call vote.
Ms. Bride,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hawquist,
Aye.
Mr. Kenny,
Yes.
Mr. Maggi,
Yes.
Mr. McBride, I'll come back to you. Mr. Provost,
Yes.
Ms. Spoon,
Yes.
Mr. Udries,
Yes.
Mr. Wallace,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman,
Yes.
Mr. McBride,
Yes.
and all votes are in, and the motion passes 13-0.
Great. Thank you. And thanks very much to Jean and Alice. Appreciate your work and your time.
Okay.
Thank you.
Take care, everyone. Bye-bye.
Bye.
Bye. Take care. Be well. Okay, I'm going to suggest at this time that we take a 5-minute break. Just 5 minutes. So we'll be back here at, 10 after, 11 or 12 after.
Okay.
Okay, good, everyone?
not really, but.
I can by default, I muted everybody.
Uh-huh.
And so when you come back from the break, you can tell them, I muted everybody. When you're ready to speak, unmute yourself.
Okay.
Because people won't really.
So I can just unmute me now. And okay, everybody can hear me now. Carol, can you hear me?
Yeah.
Okay.
Yeah. Okay. We're all back.
Kind of. Everybody can mute themselves now, or we're coming back into session.
I'm back, Charlie here.
Okay.
Let's just do a really fast roll call of the board, please.
Okay. I know you're here, Carol. So, Ms. Coleman,
Here.
Mr. Battaglia,
Here.
Mr. Hallquist,
Present.
Mr. Kenny,
Here.
Mr. Machi,
I'm here.
Mr. McBride,
Here.
Mr. Provost, Ms. Spoon,
Here.
Ms. Spoon,
Here.
Mr. Udries,
Here.
Mr. Wallace, Mr. Shearson.
This is Kirsten, I'm here.
Okay, Mr. Kaufman,
Yes, here.
Mr. Wallace. We're only missing Jeffrey.
Okay, no Jeffrey. Okay, we'll go ahead then. I'm sure he'll be right back.
Okay.
Okay. Great. Okay, next we're going to move into our committee reports. And the first one is Audit Committee with Bobby Spoon.
All right. The audit committee met on Wednesday, and we had one action item, and that was to approve the 2021 internal audit plan. Sarah Dixon presented the plan, and it was approved by the entire audit committee. It included the 2021 plan, includes 3 operational audits and 2 IT audits, along with other miscellaneous activities. We had information items, 6 of them, where no action was requested. We heard from the partner for the external auditors, and we got the audit services plan for 2020. They discussed the scope of services and the deliverables and the audit timeline, among other things. We heard the SDCERS internal annual audit report for the year 2020. Sarah presented the internal audit annual report, and it was according to the International Internal Audit Standards and the SDCERS Internal Audit Charter. The third one was the proposed audit committee for the coming year, and we have 2 scheduled dates, and we'll add a third if necessary. The fourth item was the overview of the compliance program and staff's recommendation to adopt ethics and compliance program changes to the charter. And we'll hear more from that in the B&G committee report. And we got the staff's recommendation to approve the changes to the policies for the committee charter related to the changes in the number of meetings for the audit committee. We received reports, both written and verbal, on the internal audit division and the IT division report and legal and compliance. And we did have one closed session item, and that was the report from both Sarah Dixon and from a contractor from RSM, Mr. Alfred Coe, who presented the Information Technology Security General Controls Audit. And that was it.
Okay, so thank you very much for your report. And my understanding is that the approval of the audit plan that you voted on is not a board action item.
That is correct.
Okay, so we have nothing that we have to approve at the board level, but again, thank you to the audit committee and for your report, Bobby.
Certainly.
And we will now move to the disability committee, Charlie Hawkwood.
Oh, hold on, I'm trying to unmute myself here.
Okay.
Can you hear me?
Yes,
Yeah.
we hear you.
Yes, the Disability Committee met yesterday. We had a full attendance of all the members. We had 5 action items, which we'll put to the consent vote in a moment. There were 3 that were recommending approval to approve disability retirements. One was a recommendation to approve a continuance for a disability retirement hearing. And the last one was a recommendation to deny an industrial disability retirement application. The committee discussed all the items and they all passed unanimously. And if anybody has any questions or comments on any of the items, we'll pull them. If not, I'll make a motion that we approve those actions for the consent.
Great, thank you. And there's no second required, so Cynthia, please call the roll.
Ms. Broad,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny,
Yes.
Mr. Maji,
Yes.
Ms. McBride.
Yes.
Mr.
Yes.
Provolos,
Yes.
Ms. Spoon,
Yes.
Mr. Udries,
Yes.
Mr. Wallace. Oh, Jeffrey's still not back. Mr. Shearson,
Yes.
Mr. Kaufman,
Yes.
Mr. Wallace still isn't back yet, so I'm gonna go ahead and move on with the vote. All votes are in, and the motion passes 12-0.
And the last item we had for disability, we did have a status report. Our applications are still coming in. Everybody, even though they're shut down, staff is working very diligently in processing applications. And if you look at the status report, you'll see that we're getting to the applications in a very, very timely manner. And from my experience 15 years ago, it's like they're supercharged and doing a fabulous job. So I want to thank the staff.
Thank you.
And that concludes the disability report.
Great, okay, thanks so much, Charlie, and thank you to the staff. Okay, next we are going to turn to the B&G with Nafi.
Fantastic. We had a great meeting yesterday. There were 4 action items. All of them passed unanimously. On the first action item, there was an overview of the compliance program, and the presentation was given by Rebecca Walker and Johnny Tran. Rebecca was a consultant that came in to help with the compliance overhaul and the ethics and compliance charter. So her presentation ran way over 7 minutes, but I think it was a good presentation anyway. The second action item was staff's recommendation to amend the educational policy, the ethical conduct, compliance, and training policy, and the information technology policy. The third one was staff's recommendation to amend the board meeting policy, committee charter, audit committee charter, board process on selection of independent non-board members, and audit committee, and board process for review of internal auditor. And the last one was staff's recommendation to approve a contract with Dell Technologies to increase data storage capacity. So with that, I'll move those action items for board approval.
And we
Great,
are ready
please
to
call the
vote.
roll. Yeah?
Ms. Broad,
Yes?
Mr. Battaglia,
Yes.
Ms. Coleman,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny,
Yes.
Mr. Maji,
Yes.
Mr. McBride,
Yes.
Mr. Provolos,
Yes.
Ms. Spoon,
Yes.
Mr. Udries,
Yes.
Mr. Wallace,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman,
Yes.
and all votes are in, and the motion passes 13-0.
Fantastic. We had one information item that was dealing with the compliance with the board policies report. So this is a new report that Johnny put out that kind of goes through and itemizes staff's efforts to comply with board policies. There were no questions or comments on that. On the reports, we had there were 9 reports in the material. There were 2 reports that were highlighted. Cynthia gave her Member Services Division report. She highlighted staff's work in adapting operations to serve members only, or members remotely. Good Lord. I'd asked for a report. We were blindsided by the fact that we could not operate the call center remotely. Cynthia, I want to be really clear. Cynthia's team did a phenomenal job handling everything and dealing with members' questions, but it took the form of an email had to come in. The call center then would return those calls from their private cell phones or home phones. And so that was clearly a blind spot. So my request of management was to say, hey, look, I'd like to get some understanding of how management intends to go and look for additional blind spots and to figure out how to best capture these sort of contingency gaps that we might have, or at least to go look for them. So I believe Greg has agreed to work on that for our next meeting. The next report was by Marcel. She, with regard to Benefits Administration Division report, she highlighted that there was a recent increase in the number of service retirements and drop entry retirements. This is anticipated to be a temporary workload increase as city employees were previously delaying their retirement dates to maximize the impact of city pay increases on their retirement benefits following a 10 to 12-year pay freeze. So all in all, I think it was a good report. The rest of the items, there were no questions or comments. I would just like to conclude by thanking my committee once again. They do a great job of pre-reading this material. Management does a great job of writing their reports. They make it easy for us to understand and deal with. And so I just want to, A, thank management for the reports, and B, thank the committee for reading the stuff because it helps our meetings move along timely. With that, if there's no other questions, I'll turn the meeting back over to Carolyn. Carol.
Great, thank you so much. And I know we all join you in thanking the staff who are doing extraordinary things in extraordinary times. So thank you very much. And next, we will turn to the Investment Committee.
Yes, thanks. The Investment Committee met yesterday, and we had one action item, which was to approve an allocation to William Blair in the U.S. equity portfolio. It would be about 6%, and this is a mid-core mandate. We also had a number of information items, including the risk attribution study, which was very interesting. And I think we're going to walk through that here. And then other information items that we had was the total fund performance, which we're going to touch on, as well as the real estate performance report, the private equity and infrastructure performance, the DWS update on that liquidation, the SEC lending update, and the securities litigation annual report, as well as other investment division reports. Without further ado, I will turn it over to Anders to walk through the William Blair recommendation.
Thank you, Karina. Good morning, everyone. Good to see you, and hope you're all staying healthy. First, I thought I would go through just a quick background, then a little bit about the search process, and finally a quick summary of the manager, William Blair. So as you may know, at the March 2020 board meeting, the board approved the recommendation to move SDCERS' U.S. equity structure to a bias-free approach in line with the U.S. equity market based on market cap and style basis. Benefits of this change include, among others, that it eliminates any structural biases that we talked about earlier in the manager structure and asset allocation review, and further reduces the risk in the U.S. equity asset class by eliminating these structural biases. It also consolidates the numbers of managers to allow each one to have more meaningful impact on the total fund. and it also further reduces the cost of SDCERS's U.S. equity index exposure. So a part of this move to the new structure meant replacing SDCERS' existing U.S. small cap allocation with a new U.S. small mid cap mandate. So as Karina said, the recommendation in front of you is to allocate 6% of the U.S. equity allocation to the William Blair SMID Core Fund to fill that mandate. So the search started as a staff and consultant engaged in discussions with several companies that were potential fits for SDCERS' new SMID cap mandate. We then narrowed down the list to the top 2 candidates, and after discussions among staff and Aon, the top 2 candidates then went through a deeper review to analyze their potential effects on the U.S. equity asset class, as well as the total public equity allocation within SDCERS's portfolio. We then performed due diligence visits to both managers via video conferencing. And after the due diligence visit, staff and Aon agreed that adding William Blair would be the best fit for SDCERS and would help achieve the goal of a bias-free manager structure within the U.S. equity asset class. So a little bit about William Blair. They are a buy-rated strategy by Aon. Their investment philosophy focuses on finding quality companies with durable businesses who exhibit strong financials and sustainable business models run by strong management teams. Some of the key features we felt put William Blair at the front of the pack were their clearly defined investment philosophy and process, their robust and transparent risk management framework, their long tenured and experienced investment team, and the fact that portfolio managers are so involved in the research process with the analysts. And with that, I'd be happy to take any questions.
Hearing no questions, should we go to the motion, Karina?
Yes. So there is a motion in front of you to approve staff and consultants' recommendation to hire William Blair for a mid-cap U.S. strategy for a 6% allocation inside of the U.S. equity portfolio. So I will make that move.
And Cliff Scherson will second.
Actually, we don't need a second, but thank you very much. And we can go to the roll call.
Ms. Broad?
Yes.
Ms. Coleman?
Yes.
Mr. Battaglia?
Yes.
Mr. Hallquist?
Yes.
Mr. Kinney?
Yes.
Mr. Maggi?
Yes.
Mr. McBride?
Yes.
Mr. Provolos?
Yes.
Ms. Spoon?
Yes.
Mr. Udrys?
Yes.
Mr. Wallace?
Yes.
Mr. Shearson?
Yes.
Mr. Kaufman?
Yes.
And the motion passes 13-0.
Okay, great. The next item that we went through yesterday at the investment committee meeting was the risk attribution analysis, and I believe Anders is also going to walk you through this one. I was really impressed with this report, and I hope you are as well. I think it's very important that we look at risk in a disciplined fashion, and this report gave me comfort that we are certainly doing that. So, Anders?
Thank you again, Karina. And I think I'm going to need slides for this one. Can we get the risk attribution study from Aon up on the screen? Thank you. And, okay, so one of the goals of the fiscal 21 action plan is conducting a risk reduction analysis to evaluate conditions that may necessitate reducing portfolio risk in the future. The first step in conducting this analysis is to perform what's called a risk attribution study. risk attribution study basically is a study that decomposes the risk in the portfolio in order for us to see where the risk is coming from. And understanding where the risk comes from can aid the board in making more informed investment decisions and help create a framework for risk reduction actions as needed in the future. There are an extreme amount of risks that affect an investment portfolio in a public pension plan. So we're going to just take a look at the major risks that have the largest impact on performance of the total fund. So if we can move to page 7 or slide 7, I guess. One back. There you go, perfect, thank you. So on this page, Aon identified the key investment risks relevant to the total fund. And as you can see, the dominant risk is policy risk. This risk is managed through the asset liability study and the asset allocation process. And if we can move to slide 15, page 15. One more. I should have maybe back a little bit. Slide 15, I think. It's the line with market scenarios. One more.
Bear with me, there are no page numbers on the slides that I have.
I know. There you go, perfect. That's the one.
This one?
Before that.
This one?
The one before that.
That one?
One more back, sorry.
That one?
Hey, perfect. So here we're using different market scenarios to project how we expect the total fund to behave based on the policy allocations that we set in the asset liability study and the asset allocation process. So, I think, Carol, you asked a good question yesterday about the base case being 5.5, and that's being below our current actuarial rate of return of 6.5. And as Katie mentioned then, I think it's worth kind of revisiting. So when we go through the asset allocation that we went through just now, that's based on 30-year capital market assumptions, and this is based on 10. So there are really two different things that affect this number. First, the time period, the amount of years you use in your capital market assumptions, and what time period in history that you start them. So if you are at the top of a bull market, you're going to have lower capital market assumptions than if you're coming out of the depth of a recession. So these numbers are based are as of 12/31/2019, when we were pretty much at the top of the market, which is why that 5% number is going to be there. And I think Steve Voss mentions it pretty well when he says we're reaching into the future and pulling returns and using them now instead. So that's the explanation for the 5.5. Then so if we can move to slide 18. There we go. So we can also further decompose the risk that affect total fund by a risk factor and by asset class. So on this slide, we're reviewing the asset classes to understand which ones drive investment risk. And as you can see here, risk is fairly evenly spread among our return-seeking asset classes, which is where we want to see risk come from. And we can also see that the risk is mitigated somewhat by the lower risk in our risk-producing asset classes, which would be U.S. fixed income. And so if we move to slide 23. Next one. There you go. Thank you. So when we look at what factors drive investment risk, you can see that equity risk is the dominant risk factor affecting the total fund. This is true of most long-term investment portfolios. And what can help there is diversification will help reduce equity risk concentration, but it doesn't really eliminate it because there is risk inherent in just investing in the stock market. One of the reasons for implementing the Managed Futures program, though, last year was just, in fact, to help reduce the contribution from the equity risk factor. So the conclusions I think we can draw from this study is that SDCERS has the risk management tools and processes in place to ensure appropriate implementation of the investment program. For example, as we noted earlier, total fund risk is driven by the mix of SDCERS' return-seeking and risk-reducing assets that are set in our asset liability study, which is the mitigant there. So that's all I had on the risk attribution study. If there are any questions, I'd be more than happy to answer them.
Okay, great. I didn't hear any questions from other committee members, but again, really interesting to see the breakdown of risk and also to review risk maybe from a non-investment stance as well. So looking at governance, et cetera. Okay, I believe that we also want to cover under the total performance at a high level.
So performance for the first quarter of 2020 was negative 11.5% net of fees, lagging the benchmark by 1.1%. Most of that underperformance, or actually all of that underperformance, came from our experience with Allianz Structured Alpha, unfortunately. And the return for the fiscal year as of March 31st was negative 5.1%, lagging the benchmark by 1.5%. We have run the numbers for the end of fiscal years as of 6/30, and we estimate, these are only estimates, so it may change, but rough estimates are a return of negative 0.25% for the full fiscal year. And even with all these issues with Allianz, the total fund actually managed to place in the top quartile compared to its peers, as you can see on the slide right here, which is pretty good. And then fiscal years, I think you see the same thing there as of March 31st. So I think that's all the comments I had for total fund performance, unless there are any questions.
Okay, any other questions from committee members? Otherwise, I think we can agree it's a strong set of returns, even given the unfortunate instance with Allianz on their Structured Alpha product. I will now turn it actually over to Liza. She has some comments on Allianz convertibles and managed futures.
Thank you, Karina. I just want to make a few comments on some actions that staff has taken in response to board members' requests at the May meeting, and that applies to the two existing convertible bond strategies and managed futures strategies. So first of all, investment staff and Johnny Tran worked with outside legal counsel to review the contracts on these two strategies to determine SDCERS' ability to require the manager to provide additional risk and trading reporting. We followed that up with a call from a number of people with Allianz this past Wednesday to discuss some additional reporting. And at a high level, that included quarterly calls with their independent risk group to cover risk analysis, and also that they would provide us a monthly summary report of that analysis. They also agreed to provide additional risk metrics to be added to the monthly compliance report, which they already submit. And also they agreed to provide quarterly calls to discuss trading activity on trades, walking us through the inception through settlement on a trade, as well as monthly trading reports and an annual review of trading practices. Allianz has also completed Aon's operational due diligence questionnaire, which was submitted, I believe, on Wednesday. And that staff and Aon, we will work together to provide a summary of the results at the September board meeting. And I can take any questions.
Liza, could you share with us your and the staff's summary of the perceived, your perception of the attitude towards being constructive and helpful on the part of the different people at Allianz? Just a summary statement, perhaps.
Sure. Good question. I was very favorably impressed. I was not sure that we were going to get all of the additional reporting and calls that we were asking for. We had a pretty long laundry list, and they pretty much agreed to everything. So they were very cooperative and want to be proactive in giving us whatever kind of data and reports that we need.
Thank you.
Okay, great. The only other thing I'll mention before closing out this section is that we did a request for an update on our real estate portfolio, just given COVID and the market stresses that particularly retail properties as well as some office properties, maybe longer term multifamily type properties might be going through in the current environment. So we got a quick update on the current status, and we expect something more formalized at a later meeting. And with that, that is the end of the investment section.
Very good. Thank you, Karina. Thanks for your report, and thanks for the staff's excellent work on the mid-cap search and the risk attribution study, and all the other great things you guys are doing. Okay, so we're nearing the end of our main meeting. We will be going into closed session, but at this time, I'd like to ask if there are any board member comments on any topic whatsoever. Hearing none, staff and staff, yes, comments from staff.
Yes, this is Greg. I do have some comments to provide. I'd like to provide the board a SDCERS operational COVID update. And now we have 4 months experience working with our decentralized operations since the first day of the Thou Shalt Not Gather restrictions. And since that day, staff has successfully delivered the March, April, May, and June monthly retirement payments to retirees and beneficiaries. So that's job one, and we successfully got that completed. But looking back after the past 4 months, there have been a lot of lessons learned that we could have been better prepared and done a better job servicing our members. For one example, since the onset of the pandemic, we immediately began planning to implement a remote call center. I think Mr. Provolos mentioned this previously.
Yeah, but
And thankfully, we will implement much sooner than expected. Please know that I believe staff did a great job about being responsive to this very difficult situation that we found ourselves in. We developed and implemented new business practices that we anticipate will stay with us beyond this pandemic. The disaster really opened our eyes about how we could expand our service choice for our members by offering member counseling webinars, using phone counseling tools, and also leveraging our internet-based member services contacts. To date, we've been very fortunate to avoid anticipated staffing shortages due to employee illness, self-quarantine, family obligations, and people being unable to get to work. However, the building in which we occupy over the past 4 months has sent us 3 notifications of other tenants with COVID infections in their workplaces, and with the last one coming the day before yesterday. This, combined with the state and county health officials' warnings about a second contagion wave, further reinforce that we should continue with our remote teleworking staffing plan and remote board meeting format. And I would like to close my COVID update by expressing my deep and sincere appreciation for the staff who have really adapted to a new business norms, have done a great job in servicing our members during these past 4 months. And I'd also like to express my appreciation to you, our SDCERS board, for your leadership during this time and flexibility as we adapted our own governance structure. I really appreciate that. A couple other items of interest. I wanted to give a special shout out to Johnny Tran and Rebecca Walker for developing a sound compliance program. Johnny and I have been talking and working about our compliance program, I think, since the very first day I joined the team, and I'm just really excited about the effort that he's put in and coming here and really formalizing our compliance culture. So thank you very, very much. Another shout out, this one to the entire leadership team, but specifically to Marcel Rossman, Cynthia Queen, David Bond, and Luli Silva for their work taking care of our fellow coworkers here at SDCERS over the past 4 months. Decisions are being made with people in mind. Those that are the people that we serve, and most importantly, the people that do the serving on our behalf. Another shout out, this one to all of our plan sponsors, the city, the port, and the airport. They all made their July 1st annual actuarial determined contributions in full. Due to the extreme financial distress being faced by all businesses, including our plan sponsors, we were concerned about their ability to make upfront payments and may need alternate payment plans during the year. But this is really a true testament to their commitment to funding their retirement plans and providing their ADCs as of July. And lastly, I'd like to say the CEO salary survey, which was by board policy supposed to be included in your July meeting materials, will be included in your September meeting materials, and I apologize for the delay. Thank you, and that concludes my comments.
Well, thank you very much, Greg. That was a great summary, and again, it goes without saying that everyone is doing a great job and under very unusual circumstances, and kudos to you and the leadership team and the staff.
Carol, may I ask Greg a quick question?
Please.
Hey, Greg, what was the city's ADC that was paid in July? I'm going to be asked that question at the Tuesday REA meeting.
I'm gonna call a friend and ask Marcel to give me the exact number.
$365 million.
Thank you very much.
Sure.
Okay, great. So that concludes the regular portion of our meeting. We're now going to go into closed session. If you are not part of closed session, please terminate your Zoom meeting, and we will wait a few minutes for Cynthia to get things in order, make sure we have the right people, et cetera.
Hey, Greg, are you still there?
because now we need to invite the public back into the Zoom meeting. So this will just take a couple minutes before we start.
Okay.
That's assuming that
Let
we're
me
done
just
with.
say it was nice seeing most of you, and I will be leaving the meeting now.
Yeah, I think it's okay if people want to leave, right?
Yep.
Yeah,
That's
okay.
the dictate rule.
Yeah, thank you.
Thanks. Bye, guys.
Good to see
Bye,
you.
everyone. Thank you, everybody. See ya. See ya. Thank you.
Thank you.
Okay, this is Charlie signing off. See you next Zoom.
Well,
Are you ready, Michelle? Oh, that was quick. Okay, Carol, we're
Bye,
ready.
everyone.
are we ready?
Weekend.
Yes.
Okay, great, Mike. Yeah, okay. So let me just say that the board met in closed session to conference with legal counsel on existing litigation and to discuss the public employee performance evaluation for the chief executive officer and the chief compliance officer, and there is nothing to report out at this time. And with that, if there is no more business, the meeting is adjourned.
Okay.
Thank you very much.
Thank you, everybody.
Carol, Craig, Karina.